Hey everyone, I know the news about the coronavirus hasn't gotten much better, and the stock markets are reacting with some really sharp declines. If we go back to February 19th when the market started falling, we can see that it's come down nearly 18% in a very short period of time. When the markets opened this morning, the decline was so sharp that it triggered a circuit breaker where trading is halted for 15 minutes. Now, this tripping of this circuit breaker is being talked about a lot on the news, and it is pretty rare, so I wanted to briefly cover what this is and how this works before I share some other thoughts. So this version of the trading curbs or circuit breakers I'm referencing here is for the broad market and not those that cover individual stocks. They work like this. If the market is down more than 7% from the prior day's close, trading is halted for 15 minutes. This is level 1. If the market further declines, where the total is down 13% or more, the market is once again halted for 15 minutes. And if the declines breach the 20% mark, the market will close for the rest of the trading day. Now, these limits were put into place after Black Friday in 1987 in order to reduce market volatility and some of the panic-driven sell-offs. It was meant to give the floor traders some time to reconsider their transactions, let things cool off a bit. But these circuit breakers are probably even more important now that most trades aren't placed by floor traders, but are based on algorithms. And as you may have guessed by the news coverage, these circuit breakers aren't used very often. So you may be asking the question, is this market decline unusual? Well, it may have gone down fast, but the fact that it's declining is not unusual at all, nor is this an indicator of how the market will perform for the remainder of 2020. Let's look back at history for just a moment. Since 1980, within each and every calendar year, the stock market has experienced a decline between 3% and 49% at some point during the year. But if you compare that to how the stock market finished the year, we start to see why the market rewards those who are patient and willing to ride out the downturns. In 30 of the past 40 years, the market has had a positive return despite these intra-year losses. And while past performance certainly doesn't guarantee future success, history does tend to repeat itself. So what should we do? Well, probably nothing. You need to just go back to enjoying life and don't worry about what's going on with the market. I've always said we're not going to react to downturns with our investment strategy. Shifting assets around in an attempt to avoid further loss will often just cause a lot more damage. Instead, we're just going to begin with the assumption that these kind of downturns will happen, and we're going to stay diversified in preparation for those. I know that diversification alone doesn't protect against declines, but it can blunt the impact. You know, last year, a lot of people were starting to question why they own bonds in their portfolio. The stock market was doing fantastic, and every dollar invested in bonds was a dollar that wasn't participating in the incredible performance of the stock market. But take a look at what's happened in the past few weeks with the stock market as compared to the Vanguard Bond Index ETF. While the stock market is down nearly 18%, the Bond Index ETF is positive. And this is why we continue to stay diversified. Now, with all of that said, I'm aware that this is a very unsettling period, so if you need to talk or want to go over your portfolio, don't hesitate to get in touch. Have a great day.